Hey folks, I certainly hope this message finds you healthy and doing well in this very difficult environment. We wanted to do something a little bit different this week. We've been sending you emails trying to describe what's going on in the market to you to keep you informed. This week we thought a video where we shared some charts and some data with you that showed you, I think, in a little bit better context of what's going on would be helpful. I'll also show you how what's happened in the markets compares to what's happened previously in the markets might help put some of this into context, and then also share with you where we think this might be going forward. Of course, we're never going to try to predict the future, so to speak, but certainly we can use history as a guide and help us make better informed decisions. So bear with me, I'm going to share my screen with you and go through some charts. The first chart we're going to go through here today is a chart that shows the performance of two indexes over the last 40 days or so. The first index is the blue line at the top. That index is a combination of all the investment in high quality bonds. In the United States, it's the U.S. Aggregate Bond Index. It includes U.S. government bonds, treasuries, and high-quality investment-grade corporate bonds. So it's meant to be an index that really tracks how the bond market does as a whole. And then the other line on here is this gold line. This gold line represents the S&P 500 index. It's the performance of the largest 500 stocks in the United States. And we drew this chart starting on February 12th, which marked the approximate high in the Dow Jones Industrial Average. This chart is the S&P. It actually peaked a few days later on around the 19th or so. So it's a little bit different than the Dow, but roughly the same. And so the starting point for this chart is 100. It's basically the equivalent of you putting in $100 on that day and what's happened to it since then. So you can see if you put $100 into the S&P 500 index on February 12th, on Monday of this week, that $100 became worth about $66. So you lost about 34% of your $100. So a 34% decline in the S&P 500. Since then, we've had a nice little recovery start. As of close of business yesterday, the number is now probably a little bit closer to 75 or 76. So we've had a nice little recovery, or at least bounce off the bottom. But top to bottom, it was about a 34% decline. That same $100 that you put in the bonds when the market first started going down was doing what it was supposed to do for you, which is protect your value when the stock market's going through a correction. And that was working for really the first month or so of this correction. Certainly the first 2 or 3 weeks of the significant part of the correction. But all that changed on about March 10th. And all of a sudden on March 10th, liquidity in the market froze up. And what that simply means is on or about that day, a large amount of investors, the vast majority of investors that were active in the market, were looking to sell and raise cash. They were looking to sell basically anything they could, and there weren't a lot of buyers out there. So it didn't matter what you were trying to sell during that period of about March 10th to give or take March 20th. During that 10-day period, if you had an asset to sell, you were trying to sell it, and quite frankly, there weren't a lot of buyers, so virtually every asset class took a hit. If we go over and look at the chart of the this aggregate bond index, again on about March 10th, we started to have a pretty significant correction. That correction lasted all the way to about the 20th. That's not normal for a bond market during a stock market correction. It just was such a liquidity crunch. There was nobody out there to buy assets. And the same thing happened with municipal bonds, a very significant correction, actually a greater correction in municipal bonds than there was in taxable bonds. And then the same thing happened with gold. Gold usually is a good store of value. It's usually a good hedge against a stock market crash, but during that week it wasn't working. Now, since then, of course, all of the things have started to get a little bit better. You can see gold has made a nice rebound. Municipal bonds have made a nice rebound, not quite as good as gold, and general bonds have made a nice rebound all since then. And the reason that rebound really came about is relatively simple. The federal government, the Federal Reserve in particular, stepped in and started a couple different programs to help support the people that needed liquidity, the places that needed liquidity. They have vehicles that are in place that are intended for that purpose, the repo market and quantitative easing procedures that allow them to go out in the marketplace and either take certain types of investments as collateral. So they normally take treasuries and agency bonds, but they open that up to be municipal bonds and corporate bonds. And they also started quantitative easing programs where they were buying bonds to help support the market. Those two things created a lot of liquidity and really helped calm the markets down. And so far, those actions have worked. So to put this into historical context, we have a stock market that is now, as I said, down 34%. A week ago, this chart shows the 13 worst corrections in the stock market, ranked from worst to, I guess, less than worst. As of the printing of this, which was March 18th, this current correction was the 13th worst. That has now changed. It's now around the 8th worst correction of all time. So pretty significant correction, but also what you can see is we've been here before, and it's really about what happens now going forward. The one thing that we don't know yet is the market actually in? You can see these question marks here. In every other case, we knew when the market actually bottomed because we can look back in history and determine when the bottom was and see what happened from there. But once the market does find its actual bottom, what you can see is generally going forward, returns are pretty good. Once you find the bottom, on average, the market is up around 52% 1 year later, almost 90% 3 years later, and 132% 5 years later. So I don't believe yet we found the bottom, but I do believe, as you're going to see in a couple charts in a few minutes, I do think we are getting much closer to the bottom. What you can also see is, given how the depth of this correction so far, as again, we're at this 34%, you can see, generally speaking, outside of a few extreme instances, the market can get a little bit worse, but not dramatically worse. It's very, very, very unusual to get to these 50% corrections. They don't happen very frequently. Again, they can happen. That's why we take the measures we do in our portfolio, but they are unusual. They don't happen with a high level of frequency. So let's talk a little bit about how these corrections typically happen. I want to kind of help relate this to what we have done in your portfolio for you over time. So this chart shows that it was produced by Ned Davis, and it shows really kind of different categories of declines in the market, from the mild to the extreme. In a mild decline, they refer to as a dip. It's simply a correction of around, give or take, 5% or more, but less than 10%. They happen with a very high level of frequency. As you can see, they happen around 3.5 times each and every year, which is obviously quite frequent. And when they do happen, they last about a month, and on average, if the market drops more than 5%, on average, it'll decline somewhere in the neighborhood of about 10%. So that 10% number includes everything that happened worse than a 5% drop. It's not just the dips, it's all other It's the moderate corrections, the severe corrections, and the bear market. So they happen relatively frequently, and on average, they drop around 10%. And then the chance of a dip moving to the next level, meaning moving to this moderate correction phase, is just 32%. Okay, so at 32%, when a dip happens, in other words, a 5% correction happens, we typically are not doing a lot. We might have a few stocks that stop out. We might raise just a small amount of cash, but we're not usually doing a lot, because the odds are only, if we do too much, the odds are only about 33% that what we've done will actually benefit you. 2/3 of the time, what we do is likely to work against you. In other words, we raise cash, the market recovers, and you're in cash. However, that's different as the markets move on to these next phases. So the next phase is this moderate correction. That's a dip of more than 10%. Okay, so again, they occur with relative frequency, 98 times over the last 90 or so years, so a little bit more than once a year. Okay, when they happen, they last about 3 months, and on average, if it drops more than 10%, the average decline works out to be about a 19% decline. So when we get to that greater than 10% mark, and just by the way, we don't actually use 5%, 10%, 15%, or 20% as our determining factor to sell. We have mathematical formulas that are driven off the actions of the market to help us determine where we want to sell. But I think what this chart does is it represents, I think in simpler terms, easier to understand terms, when certain things happen, what we do. And I will say, while we don't use exactly 10% or 15%, our numbers come out to be somewhat similar, and there's let's just say long mathematical reasons why that proves to be true. So now when you have a moderate correction, the odds of moving on to the next phase increase quite a bit. You go from just 1/3 chance that you're going to move on to the next phase to almost a coin flip, about 45%. So during that moderate correction phase, we do start to take more action. We do start to raise a little bit more cash. We might raise 10 or 15% cash, maybe even a touch more to be a little bit defensive, because we want to protect ourselves if we move on to the next phase. And the next phase is a severe correction, which is a 15% correction. Again, they occur with relative frequency, basically about once every 2 years. When they do happen, they last approximately 6 months. And on average, if you cross that 15% line, the market's going to bottom at around 28% on average. That's the mean decline. And most importantly, the odds now move from being, early on it was 1/3 in the favor of it moving to the next phase, where it's now getting closer to 2/3 of a chance that it's going to move into the next phase, which in this case is a bear market. Okay, so at around this time is when we become, we use the term max defensive. All right, we will protect your portfolio. We'll raise, upwards of 30% cash, sometimes more. In this current correction, we actually peaked out with our cash level at about 40% and had about a 5% position in gold, which is usually, as I said before, a hedge against corrections in the market. And when you move into the bear market phase, again, they happen with relative frequency, almost once every 3 years. It's happened 25 times over the course of the last give or take 90 years. And when they do happen, you get a mean decline of about 35%. Okay, so go back to our previous chart, and you can see we now are at that, bear with me, we're now at that 34% correction, so very close to the mean. So are we at the bottom? Great question. I don't know. But I think we're a lot closer to the bottoming phase than we are, than we are to having a significantly greater correction. But again, we won't know that until well after the fact. We still, on our portfolios, are pretty defensive. We did put some of the cash back to work on Tuesday when the market started to go up. But quite frankly, that cash will have a pretty tight, or that investment will have a pretty tight stop if the market starts to correct again. Okay, so let's talk a little bit about that strategy of us raising cash. Okay, and what you see here is an example. Well, not an example. This is exactly what we did during 2018. From October 6th of 2018 to December 24th of 2018, the market corrected about 20%. Okay, and what we want to show you is the actions we took during that time to put defense on your portfolio. Now, it's interesting because this example worked temporarily, but in the long run, it was a little bit of a whipsaw for our clients, because we did get that 20% correction, but it happened to just bottom there, and then the market healed very quickly, which is very unusual. But in any case, we want to show you what we're doing. So what these red lines represent is simply points in time during that correction where we raise cash, okay? And these lines are predetermined. I'm going to jump ahead real quick to this chart. This is a chart that we took a picture of in the summer. So over the summer, when the market was on a rally back, we had these lines drawn on a chart. We do this every day in our office. We move these lines around based on what's going on with the market. We predetermine levels that if the market crosses those levels, we're going to start playing defense. The first line will be a moderate amount of defense. It might be 10 or 15% cash. Then the second line is maximum defense, that 40% cash level that we just talked about. And again, these lines are determined long before we get there in the marketplace. No different than these lines caused us to take action because they were predetermined. So every one of these red lines represents a point in time where we sold. We might have sold 5 to 7% cash at each one of these until we got to this line right here, which was when the market coincidentally crossed about the 15% mark. We don't use that exact math. We have different formulas that we use to calculate where we're going to sell. These are proprietary formulas that we have worked on over years and years. But for purposes of this conversation, very close to that 15% mark. So we got very defensive there. The market continued down, but then you can see there was a real V bottom in December of 2018 that caused the market to come back. And then these green lines, what they represent is points in time where we feel the market is healing and we had to get cash back in. So early on, we got a little bit of cash back in. We fully expected the market to retest that low. It never did. And then back here, we were, basically fully back into the market. Market's healed, and we're moving forward again. Okay. So again, all these lines are really predetermined. So when we talk to you about how we're playing defense and how we structure that, hopefully this, clears up a little bit of the mechanics we use and how we're determining when it is we're raising cash. And I'm not here to explain exactly the math behind how we set these levels, but I'm here to explain that these levels are all predetermined by us well in advance of what market doing what it's doing now. They're actually, those levels are being determined at the stage where the market is still climbing, and really just are out there to be warning signs for us that if certain things happen, we better be ready to play defense. So I want to just show you the last 3 significant corrections that were on this historical chart over here. The last 3 are the 2007 correction, the 2000 correction. So 2007 was 56.8%, the 2000 was 49.1%, and the 1987 was 33.5%. So they're the most recent in history. And I just kind of want to show you what happened during those time periods. So the Great Recession, 2007 to 2009 is the most recent example. Correction from peak to bottom was 56.8%. So a pretty significant correction. That's highlighted right here. And that correction started in late 2007. Okay, you can see during 2007 time period, the market was, it found a new high, had a mild 5-6% correction, went back to its high, mild 5 or 6% correction, then eventually right in here broke out below that range it had been in. And when it did so, it really struggled to get back above that right in here, and led to the start of a sell-off. So this market gave you plenty of time to get out. It's one of the reasons we tell our clients during that time period, we did avoid a lot of the nasty down draw, because the market gave us plenty of time to become defensive in your portfolios and really helped us protect quite a bit. Our typical stock portfolio was down in the, let's say, 32 to 33% range, when the market from peak to bottom was closer to 57%. So again, still not fun to lose 33%, but it was a lot easier to recover from that than it would have been if you were down almost 57%. But what you can also see is when the market went through a bottoming process, as it dropped, it found an initial bottom and then had a very nice recovery. Coincidentally, that recovery was about 15%, not too dissimilar to what we've just encountered over the last few days. But what happened is that bottom got retested, okay? It actually got retested and then went mildly below that. Only a few percentage points, not a significant amount, give or take 7 or 8%. So it had a retest of that bottom before it finally went on its full recovery phase. So in example number 1, you can see we had a bottom, we had a retest of that bottom, and we had to retest the bottom before the market started to go back up. And here's the tech bubble. So again, I'm going to show you very similar data in late 99, early 2000. And here you can see the market started to find itself in a pretty tight range. Yes, it was making new highs, but it was also showing some modest corrections, 5, 6, 7% corrections during that time phase. It couldn't really break out into a new dramatic high, and eventually broke below the previous low and entered a correction phase. So the peak to trough correction on the tech bubble was around just under 50%, so a pretty significant correction. And you can see, similar to what I just showed you in the Great Recession, when we did finally get to a bottom, the market bottomed, okay? We had a pretty nice initial bounce off that bottom over the course of a couple months. That ended up being about a 25% initial bounce. But you can see during the tech bubble, and ultimately the tech bubble ended up, if you think back on it, flowed into a pretty significant, two significant corporate frauds that were discovered. Enron and WorldCom both ended up committing fraud with their financial reporting in 2000. That's what really caused the market to really bottom in 2000, because trust was very low on corporate reporting during that time period. So it took a little while for that to heal. So you can see there was actually 2 different retests and 2 different bounces off the bottom back in the 2000 timeframe before the market finally found its way heading north again. And then the last one I want to show you is the 1987 correction. The 1987 correction actually, in some respects, the early phases look like more like the current time period. It simply probably from the standpoint of, here we had the market making new highs going into it. No real significant signs that there were problems out there. Although this market, I will say, maybe did have a few signs, because the market really had, even though 2019 was a great year, it was after 2018 having a correction. The market had kind of gone sideways for a couple of years, but then the drop was very dramatic. It all happened over the course of, less than 2 months, really. Just a very vertical drop. But then we had off that vertical drop, we had a very nice recovery, or at least an initial bounce that was about 20% from the low, and then eventually had to retest that low. Didn't really go below it before the market went on to recover. So why do I highlight all that? Because I think history suggests that when you have a bottom like we've just made, I saw a statistic the other day from Ned Davis Research that says when you have a bottom that was made like this, or at least a correction like this, when you do find the bottom, 70% of the time you'll have a bounce off that bottom and then have to retest that bottom before the market starts to move forward. So I think it's very important to note. I don't think what we have going on right now is a permanent recovery. I would love for it to be. I would love for the trouble to be behind us, but my gut, and I don't invest by my gut, but my gut tells me that there's still a lot of, unfortunately, bad news to come out of all this, both from a human tragedy standpoint and probably more importantly to the markets, not to us as people, but more importantly to the markets. The markets are going to have to digest how much damage has been done to the world economies, and at the end of the day, they'll find the right price for stocks based on what they believe world GDP will be going forward and what profits will be going forward. So thank you very much for taking the time to watch this today. Know that we're doing everything we can to protect your portfolio and all this. As we have said to you a number of times in our writings, that the most important asset we manage is your trust. We do certainly appreciate that trust, and we're trying hard every day to continue to earn that trust. So on that note, thank you very much. Please stay healthy.